Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Well, welcome, Art Jarvis. We've been talking a little bit before we started, but Taking Stock, episode number 41. Yeah. But this is the premiere episode of winter 2025. So welcome to the new year.
Hey, same to you, and Happy New Year.
There it is, Happy New Year. Yeah, well, we've exchanged the Happy New Year greetings and so wish many blessings. We had the messy blessings with the snow all weekend long leading up to this. But hey, we've got business to tend to here on Taking Stock. Listen to Art. Yeah. Can you hear him, listeners? He's a little bit of a groan. Yeah. Yep. When I say we have business to tend to, I have in my hands. Uh-oh. Chuck took his notes, and about 1 year ago, we did the episode with Art Jarvis predictions for 2024. Yes. And I said I'm going to call you on the carpet. We're 1 year later, so here we are. 1 year later.
Here we are,
and we're going to go through. So,
all right, let's do it.
And I apologize up front, and for the listeners. To be honest, Art is just, he is flying by the seat of his pants today. I didn't give him a heads up. Make sure you go back and listen. So he's just going straight shooting today. Shooting.
The good news is there is a method to the madness, so right. I should be able to fly by the seat of my pants a little bit. So.
Well, you know what, and that's not really the best way to describe it, because obviously in your business, you're not ever flying by the seat of your pants. No. You know, like you said, there is a method to looking at the numbers, forecasting, because it's what you do for your clients, right? Mm-hmm. Always. Yeah. But for us, for the show, for Taking Stock, episode number 41, this is the fun stuff. I'll do it this way. So number A and B, not 1 and 2. A, on this episode a year ago, you said 2024 is going to be a pretty good year. Yeah. And here we are, the beginning of 2025. We can look back on 2024 now, and in the financial marketplace, in the financial world, investing and world economy and local U.S. economy, even our local Loveland economy, pretty good year.
Pleasantly surprised. I would say it was even better than a pretty good year. I would say it was a where do I put it? Not great. Very good year. How's that sound?
Very good sounds very good.
Very good. I'll take another one. Let's put it that way.
However, I know. So, and B, because before we get into the actual, by the numbers forecasts, and by category forecasts, B, on this show 1 year ago, which, by the way, for listeners, if you want to go back, it was Taking Stock, episode number 17. You can listen to all the discussion of the forecasting if you want to. Taking Stock 17. This is number 41, so 24 episodes later. You said, 24 is going to be a pretty good year, but the theme for 2024 is going to be bumpy. Yeah. And that was not to say it was going to be a rough ride, but it was going to have some ups and downs, yes?
Yeah, and in all honesty, I honestly expected it to be bumpier than it was. So, there were some bumps, and there always is volatility, but I was expecting more volatility than what we really got. There was still volatility, but my concern, especially in an election year, I was expecting it to be a little more volatile than it actually ended up being. But there were, several months or several periods of time where it was not too bad sailing, to be honest with you. Yeah, so...
Yeah. The waters, the sea was calm.
Calmer than expected, yes.
Yeah. All right, so that was A and B. Then we got into the actual forecast by the numbers. And the first thing we talked about a year ago was your number one prediction for the U.S. stock market. And you said that the I'd love to just ask you. Do you know what you said? But I'm not going to do that.
No, S&P. You're talking about S&P 500.
Yeah.
S&P 500. I believe I said 5,400.
Was going to hit 5,400.
Right,
exactly.
which it did hit it. I was right.
You know what? When I was taking my notes, I said the nice thing for Art is that that's true. However, if we're going to be honest with the listeners, so you predicted it would hit 5,400, and I think there was even, maybe a touch of, pretty confident in that, but 5,400.
You're right.
I stuck with it.
Yeah.
However, it surpassed it. Yes,
by a nice margin.
So where did we close out?
Well, we closed out at I don't have the exact number, but 5,800 and something. Yeah. But we actually hit 6,000.
Right.
Yeah, which was surprising. Well, and the big chunk of that came the Wednesday after Election Day, because we went up 2.5% on them the day after the election.
Right.
So that knocked us up above 6. But
confidence in the changeover in administrations and in government.
And it was
pretty
surprise.
Strong after the election.
Yeah, and I think we talked about this in the last episode, or one of the episodes recently, was that it was a surprise. I think the Wall Street and Main Street was surprised.
Right.
No, by the outcome.
We spent some extensive minutes talking about surprised. Mm-hmm. And what did that mean, when you said they were surprised? And so, we covered the fact that they were surprised in a good way.
Yeah, no doubt. So we got a nice little extra kicker, that's for sure, in the S&P 500. The interesting thing is, and once again, something else we've talked about is, the S&P 500 as a weighted index with the bigger companies having a bigger impact. So the S&P 500 was up 23%. For 2024. The unweighted index was up slightly less than 13%. So there's a 10% spread between what the big companies did and what an average company did.
Wow. Yeah.
NASDAQ, which is the small size companies, was up 30%, which once again is the technology side of the equation. And just to zero in rule and do this quickly, NVIDIA was up 171% last year. Yeah. So that shows you how much impact it had on there. But I'll make one quick last point. If you take the unweighted index and you add 12.8 something percent to that and use that 12.8% on the S&P 500, guess what number you come up with?
You should get the weighted.
Well, you get 5,400.
Oh, that's
so this is me not defending myself, but I was kind of curious.
Well, there was, again, it goes back to what we said a moment ago. It's not flying by the seat of your pants. Right. There is a method and a method to the forecasting, and there has to be, because ultimately, you're investing for your investors, for your clients.
Right.
And they need to have confidence that you're not just saying, you know what, this looks pretty cool. Yeah. Hey, let's try that.
Yeah, throw a dart at it. We'll let the monkeys pick. They use the Wall Street Journal used to do that. But
how about a hamburger with guacamole?
Okay.
See? But now,
California style.
It's on fire.
But here's the thing, and this will be kind of the common thread throughout this whole discussion here, is that we went through at least a couple years talking about the impending recession.
Right.
The point is just didn't see it. The rhetoric didn't match the numbers, and that held true.
Yep.
Okay, now some things did better than I expected. Some things didn't do as well as I expected, but they were positive. We weren't fighting up against a recession or an impending recession.
Right.
We were moving along with economic numbers and markets that were improving.
Well, no, and again, offline, this is what you talked about, and we talked a little bit offline before we started, today's show, which, by the way, this is Wednesday, January the 8th. Folks, you're used to hearing, listeners, you're used to hearing us come in on a Tuesday. The snowstorm here in the Cincinnati area gave us a break yesterday.
It did.
On Tuesday. We said, we could have got together in Studio A here, but why risk out, unnecessary travel and getting away. But anyway, so here it is. It's Wednesday, January the 8th, if I got it right. the date.
You got
But to finish off that number one U.S. stock market, S&P will hit 5,400. You also said based on that, and I'm going to go through quickly on a couple things. You also, based on that prediction, the Dow Jones would be at about 42,000. Again, so going back to we'll hit 5,400 S&P. On the day you made that forecast, we were at 4,880. It had closed out 23 at 4,700. So it went from. What's interesting is that day was 4,880, 58, so 1,000 points,
Right.
and again it went 1,200 because it got to 6 at a certain point. The Dow, when you made that, saying, hey, based on all of the reasons that the S&P will hit 5,400, the Dow will go from 38,000 at the end of 23
Right.
to closing 24 at 42, and you were saying that it closed, or it's at like about 42,550,
Right now
600.
today, so when we're actually up 1% or so. So yeah,
slightly, but
So,
you're in
close.
line. And then you just talked about some important things, which was like the tech stocks. And so along with that U.S. stock market prediction, you said which will be driven by tech,
Yep.
industry, healthcare,
Financials.
and the financials.
There you go. And guess what?
I'm glad you remembered. I actually made a note on it, but I can't read my writing.
Yeah.
But after when you said that, I said, yeah, that's what it says. It says financial. So the tech's financials, industrials, and healthcare would drive, the S&P 500.
And guess
well,
what?
the U.S. stock market would be driven by those, and they did.
They did, and probably will continue to.
Well, what I thought was interesting in the last 12 months, Art, in doing this show, was we obviously NVIDIA was at the head of the game in the tech stock world, but the tech stocks were driving it strong, and then kind of died away for a minute.
True.
During the year and came back. So I thought that was kind of fascinating to see them sort of, the tech stock, because we had that conversation on one of the shows where are the tech stocks going to falter like the .com bust? And so I'm going to throw in a mid-season prediction that you had then was no, that's not going to happen this time, and it didn't.
At this point,
So
yes.
I'll give you a bonus point.
That doesn't mean it can't happen a year or two down the road. Does
Well,
it?
yeah, but it didn't during 24.
That's right, yeah,
So
yeah.
I'm going to give you a bonus
Thank
point
you.
for 20
Okay,
for the second half of 24
Yeah.
when I was saying, hey, wait a minute, what are we seeing
Yeah.
with the tech stocks? Are they going to blow up?
Yeah, and they needed to cool off a little bit because we say it a lot. There's a such thing as too far, too fast. So
Well, and I think, you know what, on that note specifically, and the tech stocks are being driven by the increasing AI technology.
that's right.
And too far, too fast. I personally say AI needs to slow down, and the promotion of AI, because they are really, don't you think? I mean,
So
is that what
we
you
are-
feel like you're seeing a lot of AI?
Oh, it's all. I mean,
Yeah.
it's in everything. Number one. I mean,
as if it's good.
I mean, Google is giving out free artificial intelligence classes, right? So you can go on there and you can take artificial intelligence. They're really pushing it. And again, as I said, there's a good side to artificial intelligence. There's going to be a bad side to it. But
Well, I'm not an Apple guy on my phone. So you talk about Google. I'm saying that because I'm not an Apple guy.
yeah,
And I've got my Google Pixel 9 Pro. And so trust me, I know how much they're promoting, whatever ours is, which I'm ignoring so far.
right. Yeah. And here's the interesting thing. And again, I'm not making any predictions at the moment, but the artificial intelligence, and I'm going to call it revolution,
Okay.
is
Yeah.
really kind of starting to feel like the .com revolution back in the late 90s. So I think it's something to keep an eye on.
Fair enough.
Yeah.
Yeah. Well, we're gonna talk more about that because I think our next episode of Taking Stock will be your opportunity to make your forecast for 2025. We won't really do that today.
Okay, that's probably a good idea.
Remember, it's all in good fun. I don't want you to work too hard. You've got the method. You know what you're going to be able to say.
Sure.
So moving along, you also forecast interest rates.
Mm-hmm.
And, well, boy, we had much discussion about that during the year.
Yes, we did.
But you had forecast 2 quarter-point decreases in the interest rate by the Feds second half of 24.
Okay.
You missed.
Yeah.
You missed. Because those darn Feds, Powell and company, made a half point
Yep.
decrease,
Yep.
much to the chagrin of Art Jarvis.
Yep. Yeah. I'll still argue against it.
But you didn't miss by much, because then there was two,
Yeah.
and the second one was a quarter point.
Yeah, and that was at the beginning of 2024. By the time we got to the end of 2024, the quarter point cut or the half a point cut in September, I would have been okay with a quarter point. If I said they did a half a point, I would have been I still say the extra quarter point, and then the other quarter point we just got here recently, at this moment in time, is unnecessary. We've had inflation. Inflation is not jumping up, but
that's next on the list.
Yeah,
by the way,
it's perking up, right?
Yeah.
Why are we, if we're worried about inflation working its way back up again, why are we cutting rates?
I hear you.
Okay.
Well, let's jump to that.
I'll get off my soapbox.
So number 3 on your list of your forecast list for 2024 was in fact inflation, which you said we'll get down to, because it was high. Inflation will get down to 2.5 to 2.7% inflation, and we finished the year at
2.6.
So you were right there.
Yeah.
Congratulations.
Well, thank you. There's one for the good guys.
Credit where credit is due.
The interesting thing is the point that we talked about is they got us from 9 or 10% down to, at that time, what you said, 3 point something or it's like the detail work on a house. It's a lot harder to get from 3 to 2 than it is to get from 9 to 3. Okay, and I didn't, even without the interest rate cuts, which really haven't taken effect yet. But it's hard. It's hard to get to 2%. Period. And if you're trying to get to 2, it takes a bit of time to get to it. And number 3, I'm okay with 3% inflation. I'd rather not have 3% inflation on top of 9% inflation that we had. But as I think I mentioned in my work, generally the go-to number for me is that 3% number.
I was just going to say you remain consistent with the 3% being your number. So then I guess we shouldn't be surprised that number 4 on the list for the forecast for 2024 was the economic growth, and we shouldn't be surprised that you suggested we would grow at 2 to 2.5%, with that being driven by strong consumer spending, strong consumer confidence, and the interest rates dropping.
Yep.
Which are all things that happened. There was the consumers seemed to show consumer spending stayed strong.
Oh yeah, I think they just showed online holiday sales were up 9% this year. Strong. People are still spending money.
Online.
Whose money they're spending is the big question. But they're still spending.
They're going to have to start tearing down buildings because nobody needs the store. They don't need the brick and mortar anymore. It's online. Yeah. They just need warehouses.
That's exactly right.
And truck drivers, delivery drivers. I shouldn't say truck drivers, but delivery drivers.
Right. Well, they've got plenty of them, that's for sure. It's kind of interesting.
They were all off on Monday, by the way, here in Cincinnati.
Yeah, it was very quiet on our street Monday. Poor people couldn't get their Amazon packages.
Well, we got one that lives a couple doors up from us.
Is that right?
He does. He's out there. He's not like a delivery driver like UPS, FedEx, or Prime or whatever, but he's a driver like that, and he was home on Monday. Had to date, but he was back out yesterday on Tuesday.
Yeah, got to keep the wheels turning. Yeah, the economy. So the 2 to 2.5% on the economy, I thought those were reasonable numbers. We actually, if we finished 2024, actually year over year, we were up 3.1.
Right.
So the economy was actually stronger than expected. The consumer is still in it to win it, and I don't see any reason why that's not going to carry over into this year, 2025. So.
And the feeling you expressed is that if I predicted 2 to 2.5% economic growth and we finish at 3, that I'd rather be wrong on the good side than bad, and that was what it was.
Yeah, with the exception of interest, and that's the other point. But with the exception of interest rates, yeah, if I'm going to be wrong, so far we've been wrong to the side I want to be wrong to. But it's interesting to me that so we have had 0.75% drop in
interest rates
in the federal funds rate.
Oh, I
the
got
stated
you.
rate.
Okay.
We have not seen a drop in actual interest rates. We were in the high 3s at one point last year. We're at 4.6 on the 10-year right now. You look at mortgage rates have not come down and things like that. So, in fairness, it's while we have seen official cuts in rates here in the last few months, we haven't seen the rates come down on what it's cut. So, if we go buy a car or we want to go buy a house or something like that, it's still costing us a pretty good chunk of change to do that.
Well, maybe those are the factors because we haven't seen, your concern is going to be that inflation thing. Somebody's trying to call.
Yeah.
Sorry for the interruption.
No, that's right. But, it happens. Technology, it's a beautiful thing.
Anyway, that aside, thanks for calling in on Studio A, but we are
That's right.
able to take your call now.
We're not taking questions at the moment.
That's right. That was fun. Again, apologize for those listeners that are trying to call in even as we speak.
That's right. It's impressive, yeah.
But my point, as the phone interrupted, was maybe that's a reason in terms of haven't seen the mortgage rates actually drop and some
You've actually seen them go up, to be honest.
Right. So that maybe has kept the inflation rate a little bit steadier or down. However, so economic growth is where we left off, and you could say it's about 3.1% to close. This was an interesting forecast because you included the unemployment rate.
Yeah.
You suggested, well, you predicted it would hold steady and at around 3%. However, the unemployment rate actually went up a bit, yes?
Yeah, it went up quite a bit, actually. I think
Don't tell me.
that's right. Yeah, I will go with I was wrong on that one. Yeah.
But what you were talking again offline, we talked about a little bit, and you said what it was up to
4.6.
Yeah.
Yeah. So it's been perking up. There's no doubt about that. The natural rate of unemployment is somewhere around 4%.
Yes.
So when we were down at 3%, we were well below the natural rate of unemployment. So, well, again,
maybe it's a more real number at 4.8.
Exactly the point I was going to make. Because honestly, since 2020, I have felt the employment numbers have been suspect. Just especially during 2020, we were getting numbers that just didn't make any sense whatsoever. We're getting these great big huge initial jobless claims numbers, but then we're getting large unemployment numbers, but not near as large as you would have expected them to be. And then we're getting bigger swings in the job numbers, right? So it's like, okay, this number, wow, this month was really bad. It was not near as good as we were hoping it was going to be. But then guess what? Next month it swings back the other way. So I kind of look at it as a pendulum that's kind of swinging back and forth. And I think the real answer is like somewhere in the middle, right? So
fair enough.
So we'll give them. I don't know what the solution to that is, but we'll see.
Well, again, you went out on a limb on a couple of these. I felt like. Maybe not so much here, but I felt like you did a little bit on real estate. You predicted a 5 to 7% increase overall on national housing prices. And without an exact number, the national housing prices have gone up in that neighborhood.
I mean, we had a huge increase in 2023.
Right.
In the value of homes
it was unbelievable.
and things associated with it. So, I would say...
It's settled a little bit,
yeah.
I thought, this past year.
Well, your house value goes up 30-40% in a year or so.
Yeah.
you would expect a little bit of settling down the next year, right?
I would hope, yeah.
But yeah.
Well, that's a topic for another day. A different episode of Taking Stock. We'll address some of those things. This is going to really give us some, some good show topics for Taking Stock going forward in 2025. I think because it's a reminder of all those things that happen and how you can apply the numbers, which are what drives Art Jarvis and Jarvis Global.
Yeah.
By the numbers.
I mean,
Jarvis Global by the numbers.
And this is, I'm running portfolios for, some clients. These have people up in Washington and, the Federal Reserve and things like that. They're making some real world decisions on what they're trying to do, and there's so many variables and so many this is how this variable affects this one and that and things. It's not easy for these guys. I'll give them credit for that. It's not. That's why you kind of try and come up with what you think is quotation marks normal, and then try and put some swing room in both what's normal, and then try to come up with what you think is a reasonable estimation of things.
Well, the last piece of the real estate forecast by you was also a 10% increase, and you gave an example at the time: 10% increase in rental prices. And you gave an example, which I thought was a very good comment on the forecasting show a year ago, where you said, for example, if you're renting a place for $2,000 a month, a 10% increase is all of a sudden it's $2,200 a month rental, and so the second half of that was, which means there's going to be more home buyers and less renters when they realize that buying a home, you might have a mortgage payment of $2,300, and you're going to pay $2,200 in rent and get nothing.
Sure.
So buy.
Yeah.
And you feel confident, as we sit here today, that looking back over 24, that was a pretty accurate forecast, especially in terms of more home buyers, less renters, and that was reflected in the home buyers market and that increase of housing pricing.
Yeah.
Supply and demand issues.
I definitely feel that's reasonable. I think if you went out and talked to renters as a whole, they will tell you that their rent has gone up substantially, right? So, and it does. If you have the ability, those numbers that you said, 2,000, 2,200, those are real world numbers. And there are people out there that say, "Why am I doing this?"
Right.
And, you look at a company like Ryan Homes. I mean, their stock is just absolutely going through the roof because they can't build houses fast enough, right?
Right.
So there's people looking. Well, there's still a glut. You talk to the real estate agents, and they'll tell you there is still a glut of homes for sale. They're not out there. There's they're having trouble making money because there's just nothing to sell, and some are out there making money. But it's so what if you're a renter? Or if you don't have the ability to get a home, you're paying a pretty good chunk of change for rent these days.
Well, I'm glad that I am comfortably in my home.
There you go.
I'll leave it at that.
Exactly.
Then we had Wild Card Weekend.
Yeah,
no, wait, that's I'm sorry, that's football. No, but you said okay, so we covered the U.S. stock market. We covered the interest rates. We talked. Oh my gosh, we talked all year long about inflation. We covered your forecast on economic growth. We talked, surprisingly, that you made a forecast on the unemployment rate, and that was an interesting discussion as well. And now we just covered the real estate. But then Art Jarvis said, and I always have a couple of wild cards.
Yeah, have to keep things interesting.
So 1 year ago, your wild card items were the national debt will be $36 trillion. By the end of 2024. It is
36.17 trillion.
How about that?
Yeah, I'll take it.
You're home on that one. By the numbers.
We're consistently spending. Let's be clear about that. Yeah.
Well, and I remember when you threw that out there, said maybe this isn't so much of a wild card because the national debt is doing this, and based on it continuing at that pace, then we're going to be at 36 trillion by the end of the year. So 36.17 is right there. Another wild card prediction that the S&P 500 would hit 7,500 by 2030.
Yeah.
You did a calculation at that time that made sense that it would be 7,500. That was pretty conservative, using a 7% factor or whatever that is. You know that.
That one, in my opinion, unless somebody does something stupid, that's in my opinion, that is a pretty conservative.
Yeah.
bet,
Well,
to be honest with
the more common factor would have been the 10%, which you said would bring it to 10,000.
Which
That
is
seems
10,000.
very realistic.
I mean, the market historically, for a number of different time periods, if you look at them, has given you roughly 10.14% per year. So
There you go.
10% per year on the S&P 500 is not out of the realm of possibilities.
Well, and then your most fun wild card was Vladimir Putin.
Yeah, good old
Would
Vlad.
be out.
Yeah.
And I'm going to leave you off the hook on that, and because I forecast right along with you, yes, 100%, Vladimir Putin will not be the leader by the end of 2024, and by golly, he's still there.
Still there.
So we missed, you missed, I missed. However, I already heard you say, yeah, I'm going to stick with that because he's still not long.
Give it time.
Still not long. Well, so we could say, not so much a wild card, but we could say the forecast from Vladimir Putin is dark clouds and bye-bye soon.
Yeah.
Certainly before, I would say, before the end of the first quarter.
That's me. As we talked about, that's kind of, I call him the wild card. And we kind of having a little bit of fun, unless you're Vladimir Putin. But I gotta believe it's coming.
Okay.
Now, I've been, what's the thing? In the long run, we're all dead, right? In the long run, and I gotta believe I'm right. But what's the definition
His
of the
death
long?
is imminent.
What's the yeah? Well, there's that too.
I don't mean his real death.
Yeah, I
his
get you.
Political death is imminent.
Yeah, we're kind of having a little bit of fun there, but and in some ways that might be even more wishful thinking on my part. But I have to come up with a couple new fun ones.
Well, I was going to say there's
next
some
year.
room for some very interesting wild cards. I'm not going to tell you what I'm thinking, but I'll be interested to hear what wild cards you give us 2 weeks from now. Actually, 13 days, because we'll be back on our Tuesday normal rotation in 2 weeks for the next edition of Taking Stock as we close out the first 2025 edition of Taking Stock. Episode number 41 has come to a close, Art.
Yeah, that was fast.
But it was a great review of 2024 and the forecast. I think that was a lot of fun. How about you?
No, I enjoyed it. Again, I as I think I said to you, I never claim to be perfect, right? But and again, there's a method behind the madness, and you know what? If the worst thing is a 12% up market becomes a 23% up market, I can live with that.
I'll go thumbs up on that every time.
As long as I'm on the right side of the bet. So that's good. And I appreciate you doing this because it is fun and it is nice to kind of go back and review what I may or may not have been thinking a year ago. So, the problem with this business...
Taking Stock number 17 and Taking Stock number 18, you can still find them, folks.
Yes, go listen to them. Yeah.
Just Google it.
Yep.
You can find Taking Stock with Art Jarvis, episode 17 and episode 18. You can listen to what he said last year, and you know what he just said today.
There you go.
We don't know what he's going to say in 2 weeks. It's coming for 2025.
Yeah. I have to come up with something fun.
But I think I can confidently say we'll be back.
I hope so.
All right. Episode number 42 in about 2 weeks.
Yeah.
And again, Art, thank you so much for your time today with Taking Stock. It's a treat for me, too. I have as much fun as you do with it, so thank you.
Okay. Well, I appreciate you, and I hope you have a blessed 2025.
Likewise, I hope your holidays were wonderful. Christmas was great, and certainly a happy, healthy, most blessed 2025 New Year.
Yeah, thank you.
All right, until next time.
Take care.
Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.